Okay, good morning again. This is Adam Goldstein, the Chief Business Officer of the Federal Home Loan Bank of New York, and we welcome you to today's webinar. A few notes before we get started. If you have any questions, please submit them at any time through the question box, and they will be answered at the end. We're always looking to enhance the programming that we offer to our members, so we ask you to complete the survey, which will come up at the end of the webinar. We value your input and try to cater these sessions to your interests. We're here to serve you, and we relish our role as a cooperative. We also seek to add value to our members by being thought leaders, educators, and strategic partners. And we encourage you to visit our financial intelligence library on our website. There, you can listen to podcast series about LIBOR-SOFR transition, listen to past recordings of webinars. And if you have not set up a LIBOR transition office or think it doesn't apply to you, give us a buzz. We'd love to talk to you about that. We've been spending a lot of time on the phones with members talking about the great transition, as we've been calling it. You can also find publications, including our Member Service Desk Weekly, which is designed to provide insights into current market trends and news. That is available every Monday. Also on our website, you'll find details on significant events that management and the board are working directly on and events that we're speaking at. You'll find information about the launch of the new mortgage asset program set to launch later in December. If you want to hear more about a new secondary market outlet or schedule a one-on-one session with your relationship manager, we'd love to talk to you about that as well. On our COVID-19 information page, you can also find information on disaster relief efforts, grant programs, disaster relief funding, the Small Business Recovery Grant Program, and so on. There is also information about PPP eligibility for your collateral and information about letters of credit, some changes that we've made to that program, information about dividends, which is so important to you, our members, as part of the cooperative. Now, today's webinar is about asset liability management. Our friend Scott Hildenbrand will discuss some tools to help your organization navigate through these uncertain times. The Home Loan Bank remains a reliable partner for our members, with funding available to help your organization maintain a strong balance sheet in all economic environments. After this session, if you have any questions or would like to discuss strategies for using advances, I encourage you to reach out to your relationship manager. And knowing Scott, as long as I've known him, I am sure he would not mind hopping on the phone with us and you to keep the narrative going. So with that, I'd like to introduce Tom Citino, our Vice President, Director of Member Relations, to introduce the webinar. Tom, all you.
Thanks, Adam. Hey, good morning, everyone. It's a real pleasure to offer this session to you today. Scott Hildenbrand from Piper Sandler is a great friend of the Home Loan Bank of New York. He's been a frequent speaker at our events and also of the other home loan banks throughout the system. So Scott currently is the head of balance sheet analysis and financial services at Piper Sandler. So Scott, as many of you know, works with financial institutions on all aspects of asset liability management. He also runs Piper Sandler's hedging services. It's a registered swap introducing broker. He also works closely with his investment banking group and to identify and develop strategic opportunities for clients involved in M&A. And lastly, as an interesting tidbit of Scott, I didn't realize prior to joining Sandler O'Neill in 2004, he also worked at Tower Federal Credit Union and the Treasury Group, working with asset liability management. So Scott, it's a pleasure. We really appreciate you presenting today, and I think the members will really appreciate the content you'll be discussing today. So with that, take it away, Scott.
Well, thank you, Tom, and good morning, everybody. And Tom, Adam, everyone at the Federal Home Loan Bank in New York, it's an honor to be here virtually, not there together, but I thought I could get my ugly mug on that screen just so we can make it a little bit more authentic and real. But, you know, listen, it's obviously been an incredibly challenging time, you know, in every aspect of your life. But I think, you know, today we're going to talk a little bit about sort of the opportunities that are out there, some of the challenges we're facing, all related to balance sheet. And before we move off the title page, you know, what was really nice was, you know, as I started thinking about what we were going to talk about today, it was nice to say preparing for Q4 and also 2021. I think that was just nice to write as we start trying to hopefully get through 2020 and get into 2021. So with that, I think, you know, my job has always been, as you may or may not know, I get to spend a ton of time with banks, thrifts, credit unions all throughout the country, different sizes, different shapes, different issues, and about 1,000 come through my group a year. And I do spend some time with regular examiners and the regulators down in DC. And I also spend time with investors and bank stocks. So I sort of get really good questions from really smart people who look at the balance sheet from different lenses. And all I do is take all that and bring it hopefully in a concise form. And when you hang up today, hopefully you take 2 or 3 things away back to your institution to hopefully make the ALCO meeting a little bit better, a little bit more strategic. And with that topic, I really kind of wanted to talk about the first thing here and on slide 2. And, you know, one of the biggest mistakes I think I see as I was traveling around the country before COVID, and I think I did 35 or 34 different ALCO meetings in 2019. And I sort of left that after reading a book and thinking about strategy and how to help institutions with ALCO. What I realized was, and Adam and I were talking about this for a minute before, there's actually a really big difference between a tactic and strategy. And I'm not convinced enough of us know the difference. And I don't want people to confuse tactic and strategy. They play a role both when you think about your balance sheet and asset liability management. But what I think the number one thing I want institutions to do is define the difference between the two so that when you're in your ALCO meeting, you can go through your tactics, but then take a step back, higher level, and go through strategy. And I've always defined tactic as kind of knowing what to do when it's right in front of you. I'll give you a great simple example. After P, the 100 basis point Sunday afternoon Fed cut, all the liquidity being dumped in by the government by purchasing every asset that wasn't nailed down, all of a sudden we saw inflows of deposits at almost every institution throughout the country. So naturally, I've always believed cost of funds and really deposits are supply and demand. So obviously when there's plenty of supply, we're able to do what? Lower your cost of funds dramatically. So a lot of us did that. That was not a strategy. We didn't know that COVID was coming. That was right in front of us. We dropped our cost of funds as low as we could, and we started to think about strategy. Strategy, in my opinion, is much different. Strategy is knowing what to do when it's not in front of you. And I'm going to give you a great example of that. I did a webinar about 2 summers ago. So think July 2018 for about 700 or so banks. And I remember on that call, I wish I had, and I think Home Loan Bank New York has this, but I wish I had the ability to track when people hung up on me, right? Because throughout the hour or 45 minutes or whatever it might have been, because I spent about a half hour at that time talking a lot about downside risk, down rate environment, buying floors, adding duration to the asset side. And I think a lot of people looked at me like, well, wait a minute, 2 summers ago, there was still Fed hikes projected. And what I realized is that probably a lot of people hung up on me. And then the next about 12 months later, I got a lot of phone calls and people would say, Scott, how'd you know rates were going to go down? And I wish I had some fancy answer, and to sound really smart, I'm not. I can't even spell economist. But what I did understand is I understood the exposure to so many balance sheets throughout the country was not to up rates. We had had a decade-long period of time of preparing. What I was noticing was many institutions were exposed to the down rate environment. And so what we started to do were put plans in place to figure out where we were exposed and how to address that over a 6 to 12 month period of time. And to me, that's strategy. It wasn't right in front of us. It wasn't the obvious, but it was looking hard at my own balance sheet, right? Being disciplined enough to stick with understanding what your balance sheet's telling you, where you're exposed, and going from there. So I'm going to talk a little bit about what we're doing from a strategic perspective and also a tactic perspective this morning. But I think the first thing I want you to take away is make sure you define the difference between the two, tactics and strategy, in your ALCO meeting. You'll start to get people to focus and shift their attention early to tactics, but bigger picture to strategy. Okay. And really the number 2 thing, and I sort of hopefully dovetail off of the first point, you know, I find it interesting, and I think Tom pointed it out. I've been doing this. I started at my career 20 years ago running asset liability models. And back 20 years ago, 15 years ago, even 10 years ago, it was great that we could just run an earnings simulation, take interest rates up and down, ramp them, and we felt like we had a good understanding of whether we were asset sensitive or liability sensitive, right? And we kind of all went to our ALCO meetings. We felt really good. That's sort of 10 years ago. I really believe the game has changed. And what I mean by that is I go into ALCO meetings and I ask one simple question, and I get all kinds of interesting answers. And my number one question is, Do you know what part or what parts of the yield curve matter most to your institution? And a lot of institutions can't answer that question thoughtfully, and it is a little bit scary because you have to think about it. Most of us, right, we originate assets on certain parts of the curve, we bring in funding on certain parts of the curve, and we manage that spread. And so the parallel shifts, the shocks up 400 and down 100 or wherever we may go, those are productive for sniffing out, major exposure or themes. But what I've always said is I'd want to pick one or two parts of the yield curve that matter most to me in my simulations and start isolating what I should do and start thinking about strategically where I'm exposed and give my committee 2 or 3 options to how to handle it if we start to see small shifts exposing us more on those parts of the yield curve. One of the things I find interesting in investors in bank stocks when they call me and they say, okay, Scott, I want to start feeling better about margin and spread. And I'll say, well, why do you start feeling better about margin and spread? And they'll say 2s and 10s, right? And I want to show you here, and hopefully you can see this, but I isolated 2s and 10 years treasury spread, right? That's traditionally how we all grew up thinking about the shape of the yield curve. And if you think about it, it's kind of weird. I didn't even realize it until we started putting it on paper. End of 2018, we only had 20 basis points between 2s and 10s. Look where we are October 10th. We had 60 basis points. So we've actually steepened a fair amount. I don't think any of us on this webinar feel really good about the shape of the yield curve right now. Because you know what I've found is that when I start asking the questions around exposure, you know where a lot of institutions are exposed? Between Fed funds target and 5-year part of the yield curve. Most of our assets turn over at that point, right? We originate 5-year average life assets typically. And so what I've always told my ALCO committees that I work with, you need to look at, and this might not be your spread, but Fed funds and 5-year for a lot of institutions, I take it and steepen it 25 to 50, and I flatten it 25 to 50. And that starts to develop strategy, because then you can think about a realistic move. Even a board member may not fall asleep now in ALCO because you're talking about realistic moves, right? You're not going through the history lesson and talking about a year ago how you were up 400 and here's your volatility. Tell me the Fed and 5-year steepens 50 basis points. What opportunities do we have? What are we going to do strategically so that we can drive revenue, maximize spread, and minimize our risk? And I don't think that's done enough in ALCO because we're not targeting the right components to what matter most to us. So my first point was define tactics and strategy and know the difference. The second one is you better know what part or parts of the yield curve matter most to your institution. That will help drive strategy discussions much more meaningful, in my opinion, than the parallel shocks. Okay, so quickly, what I want to get into is sort of my third bullet here and third slide, and probably my third takeaway. And besides credit, I think the number 2 topic that I get asked about is around liquidity. And how fitting we're with our friends here at the Federal Home Loan Bank in New York who have been here to provide us liquidity no matter what happens, and we love them for that. And right now, we're probably not using them as much as we typically do, right? Because it's a supply and demand game. And really the question is not that I have this liquidity, right? And what should I do with it, right? If I polled 16 CEOs, right, grabbed he or she, put them in a room, and I asked them and I said, how do you at your institution strategically define liquidity? Strategically define it. Do you know how many answers I get? I probably get 31 different answers, right? Because, and I tell the examiners this all the time, it's great to have your 17 different ratios on liquidity, but if I'm going to get anything out of this ALCO meeting, I need to know what my number 1 strategic liquidity ratio is so that I can develop a plan, right? So I can understand what I can do with the cash today, what my game plan is, and what happens when, not if, when the supply and demand game changes. I've seen too many institutions parking their money in cash since March, earning 9 basis points or 10 basis points from the Fed because they didn't want to buy 1.25 to 1.5 yielding assets, which I understand in a vacuum. But well, if you have a better understanding of A, what your liquidity measure truly is strategically, B, what you're going to do, right, from a outflow perspective, and then C, you got to drive some earnings here because loan demand is slowing down traditionally in an environment where you see unemployment where it is, right? So to me, I think too many of us believe we're conservative, and I actually think it's aggressive to leave all that money sitting in cash. And you can't be comfortable doing it without a one liquidity ratio that matters most to your institution. And I'm going to talk about what I would do. And someday I hope to be in your seats and working at an institution and helping them manage their balance sheet. But I'm going to give you what I would do as if I was lucky enough to sit there. But a couple other things on the tactic side, a couple other things we're seeing people talk about a little bit. Number one, and Adam in the Federal Home Loan Bank, I'm sure you've seen this, delevering balance sheets, right? We took out wholesale funding when we needed it 2 years ago. It was the right move then. I now have assets that have appreciated in value, not just because of drop in interest rates, but because of the tightening in spreads on those assets, because the Fed's buying every asset I typically buy. So we're having institutions sell to the Fed, take that money, pay down the Federal Home Loan Bank advances for a moment, clear the deck, and then rethink about what we want to look like going forward. That's a defensive tactic. Another defensive tactic is preparing my board and ALCO for asset side hedging. Sounds really fancy, it's not. There are times it may make sense for your institution to buy an asset and swap it to a floating rate. That's a very simplistic approach, and it may make some sense, and I'm going to talk about what some people are doing today. Also, tangible book value and tangible common equity ratio protection in an uprate scenario. I know you're probably think I'm crazy, but this topic will resurface in the next 12 to 18 months. And I think you're supposed to educate your board and ALCO today on this topic. And why am I bringing this up? We are all, if we're doing our jobs correctly, going to buy assets that will be underwater 18 months from now. And that's okay. But we need to understand the impact of being underwater, what it means to my GAAP capital, tangible common equity ratio. If I'm publicly traded, my tangible book value per share, right? And understand what that means. Prepare ourselves now and talk about both economic ways to address it and accounting ways to address it. Write that down and get that on your list of things to start thinking about, again, from a tactic perspective. Finally, on the offensive side, and I already mentioned it a little bit, I love selling into the government. They're overbuying and overpaying for assets. If you look at the market yields I'm selling some bonds into, sometimes it's even negative. So the Fed's buying dumb, I'm selling to them, and I'm buying what they're not, right? And then finally, the other tactic, and we talked a little bit about it, refinance, reposition the entire liability side of your balance sheet today. Strategy development, I talked about this already. Parts of the yield curve that matter and what spread on that curve matters most to your balance sheet. That answer will dictate strategic direction for your company. Okay, I get asked this question a lot, and I wanted to put it out there. There will be arguments, disagreements with me, and I'm okay with that. But if I was sitting in your chair, this would be my strategic, I'm going to run all the different metrics, but this would be my strategic liquidity ratio so that I could put a game plan around what the heck to do with all the excess cash that's sitting on my balance sheet today. A year ago, 2 years ago, excess cash would not have been a problem. You want to know why? The spread between the Fed, what the Fed was paying you, and what you were earning in a security or a bond was so minimal it didn't really matter. Today, 100 basis points, 150 basis points on assets that you can earn matters a lot when everybody's under margin pressure, spread pressure, and growth spread pressure. So for me, I love, and I can't even spell unencumbered, but I love cash and unencumbered securities as a percentage of assets. Because I think it does a couple of things, right? It starts to make you think about your asset base. And I've always viewed liquidity. And I'm not just saying this because I'm talking at a Federal Home Loan Bank webinar. I say this at every speech I've ever given when the word liquidity comes up. Liquidity to me does not mean having cash on hand. It's the ability to, at any moment, raise cash. So if I have a game plan around how many assets I have that I could either purchase or pledge, right? So that I could sell or pledge immediately to drive liquidity, then I've got myself covered. And so what I would do is I would create and go back historically and look at your own institution and think about what your ratio is. And in this example, I went back to 2006, and you can see right at the height, right before, I think that's right before the credit crisis, we dropped down to about 17%. sort of 2012, 2013, when we were still fighting for loan demand and waiting for the economy to get going, we boosted back up to 25%. Let me tell you something, we are headed right in that direction again. And I'll bet you when I get third quarter numbers in here, that number will be higher. So you need to understand what your nominal average number is, and then start to think about how to optimize from there. Yield, return, risk, right? And obviously liquidity using this ratio and maybe a couple of others. Okay, I'm going to spend no more than a minute on this, but here are some of the assets that the institutions we're working with are buying. This may put you to sleep, but I think it's important. A lot of us have to dust off our investment policy. Some of us hadn't bought a bond in 2 years. And unfortunately, given the cash inflow, deposit inflow, and a little bit of lack of loan demand, and maybe not so much in the New York market, but some institutions that I talk to are feeling it a little bit and worried about 2021 across the board. It's really been 20-year agency mortgage backs. I love the agency 20-year pass-throughs. You can sell into the Fed, but they're a little bit wider spread, but more importantly, I almost call them the F-150 of bonds. They're liquid. They drive enough earnings. They bring plenty of cash, pledgeable asset. They kind of check a lot of boxes. A couple of other assets, and one that I wanted to bring up here in the middle that I think is important because you're going to hear your competitors doing it, and you're seeing all the bank subordinated debt being issued, right? And you're seeing this debt being issued at 4, 4.5, 5, 5.5, 6, 7.5, 7% yields. We have done, I think, more than a deal a week for the last 6 months for banks and our competitors too. There's a lot of community banks issuing sub debt at anywhere from 4 to 7%. And what I say about it is, and I wrote a white paper on why I think it's a great, attractive investment for some banks. Number one, a lot of us are seeing a dip in their loan to deposit ratio. And last I checked, we're paid to take credit risk. We're just paid to manage that credit risk appropriately. You all have a team who's ready and able to underwrite any asset, right, that has appropriate yield that you can get your arms around and understand. And so if you think about it from that perspective, and you can go out and buy sub debt of a bank down the road or across the country, however you want to diversify yourself, at 5%, you can look at the asset and say, I'm going to underwrite this like a loan. I'm going to monitor it, credit surveillance every quarter like a loan. It may live in my bond portfolio, but it's absolutely treated like an unsecured loan to an institution somewhere else, other part of the country. When you think about it that way, I started to get comfortable with it. But you know what really got me comfortable with it was, yes, we're going to do the due diligence. And yes, my loan to deposit ratio is down and I've got a credit team. And somebody said this to me once and he made so much sense. I'm not here to tell you add credit risk. I'm here to tell you replace it. If your loan to deposit ratio is dipping down, this might be an attractive asset for you. But here, really where I started to get comfortable making a recommendation on this are two reasons. One, the regulators. They've seen now this asset in bank bond portfolios since 2014. But more importantly than that, they put a hard, clear-cut limit to how much you can purchase, up to 25% of your capital. So I usually write in policies 15% of your capital you can own. So now the examiners have laid it out. There are people like ourselves who underwrite this stuff, can help you underwrite it, where to get the information on a quarterly basis. Pretty sure you understand banking. So it might be an asset that you may want to look at that can drive some loan type yield, and it just may happen to live in your bond portfolio. So something I thought was worth bringing up today. If you want that white paper, reach out to me, and we'll get it over to you right away. Okay, quickly, and then we're going to start getting into some of the strategic things that we're seeing people do as well, along with these tactics. The other tactic I mentioned is deleveraging the balance sheet. And it doesn't sound exciting, but again, anytime you can think about your balance sheet as just you're a spread manager, and there are liabilities on a lot of bank balance sheets that are still sitting there, and the assets have turned over given the dramatic prepay pickup, right? Refinance pickup, default pickup, whatever the terms we want to use. We've got assets that, in my humble opinion, are overvalued because the Fed buying so many assets. Aren't I supposed to at least evaluate selling some of those at gains, which I hate taking gains. I love losses, hate gains. But in this case, if I could take a gain and offset that gain with paying down an advance that I don't need anymore, right? Shrinking my balance sheet and creating a more efficient earnings stream. And in this example here, this bank came to me and said, well, what should we do with all our excess cash? And I said, before we talk about what's out in the world, let's look at our own balance sheet. Why do we have $30 million of assets, earning me 40 basis points less than what I'm paying out on a wholesale funding? So we matched gains and losses, shrunk the balance sheet $30 million. For this institution, it wasn't a dramatic shift of assets. And we picked up a little bit in earnings, $120,000, nothing to sniff at. That's not why we did it. You know why we did it? We increased margin 5 basis points in a world where everybody's margins are getting slaughtered. But here's the real kicker. If you went to your board and said, I just did not only a non-dilutive regulatory capital raise, an accretive capital raise of 16 basis points by simply doing something on the wholesale balance sheet that I will use again down the road when it's more attractive, why not think about doing that? And this institution, in fact, shrunk the balance sheet, then looked at their 21 earnings and said, you know what, Scott, you know what we're going to do next? We're going to lever that back up, that $30 million, at a positive 100 to 115 basis point spread with no interest rate risk, using home loan bank advances, using interest rate swaps, and buying assets. And believe it or not, you can manage that. And all of a sudden, they were the same size institution with a lot more in earnings. So it depends on capital or earnings. But either way, it's probably something you should start with when you're considering your asset allocation. Some institutions have even just used cash to pay down some of the wholesale funding at losses and just taken the loss because you're publicly traded. No offense, nobody cares about your earnings right now. They care about your credit, they care about your tangible book value, and they want to hear what 2021 is going to look like. So maybe not a bad idea to look at that a little bit. Okay, developing themes. Higher risk for tangible common equity, right? I told you to put that on your radar. I'm going to show you how I would think about it in a minute. But it's all around. All of a sudden, I have a longer and larger AFS bond portfolio than maybe I've ever had. And so typical in the bank credit union world, we are the opposite of asset managers, right? We don't just buy bonds and hope to sell them next month and make the quick gain. In fact, we're the exact opposite. We're not trying to beat a benchmark. We're trying to manage our own balance sheet. And with that, I've always viewed the available for sale bond portfolio as the front line. So sometimes when you're buying assets at all-time lows in yields, which I think you should be doing, I know sounds crazy, and maybe adding a lot of duration to protect against rates here for a while, you better be prepared for the questions that are going to be coming around TCE, tangible book value, and other comprehensive income, and what that means to you. So I'm going to give you a little bit of a decision matrix to take back to you, to your shop to think it through. The second one is asset side hedging. And Adam will probably laugh. Him and I have been doing this so long, for a long, long period of time. The words fair value hedge was almost a four-letter word in a boardroom, because the CFO, he or she, would look at me and say, I am not buying an asset or originating a fixed rate asset and swapping it to a floating rate and then applying fair value hedge accounting. You want to know why, Scott? Because there's going to be volatility in my earnings, and my CEO doesn't like volatility in my earnings. My investors, my stakeholders, my board, so not going to do it. FASB, 2 years ago, a little over 2 years ago now, came out with simplified rules around how banks can account for off-balance sheet derivative use. And thankfully, FASB finally put derivative hedge accounting in the same, economics and accounting in the same room when talking about derivative accounting. And one of those major changes they made was on the asset side hedging world. Back before the rule change, you originate a 10-year fixed rate commercial loan. And you say to yourself, that's a lot of duration. I'm a liability sensitive bank. Why don't I swap that to a floating rate, right? No problem. It sounds mathematically and economically very simple. And it is. It's done all day, every day. Problem is the accounting. And back before the rule change, the accounting required you to mark the asset that loan, and it required you to mark the swap, right, from fixed to floating. They mark each one each quarter, and the difference between the two, which in theory, one's fixed and one's floating, should be nothing. They should offset each other, and there should be no P&L issues. You know what the problem was? There's credit risk in the loan. There's minimal to zero credit risk in the swap. Interest rates may not move, but credit spreads could blow out, and all of a sudden you had a big loss in the loan. Then the swap didn't move. You had P&L impact on that. So people said, never doing a fair value hedge again. FASB got it right. Now what you're able to do, same example, same commercial loan, 10 years, you want to swap it to a floating rate. You're just now going to be marking the asset and the swap to market due solely to changes in interest rates. They realize you already have the credit risk on your book. So you've already committed to the credit risk. Now you're just using the swap for interest rate purposes. So now you mark the asset and the swap to market, and it will flow through your P&L and have minimal to zero impact because it's all due solely to changes in interest rates. That was one big change. You know what the other big change is? Before the rules, you have to say, well, that 10-year commercial loan probably might not be outstanding for 10 years, right? You used to have to swap it for the full 10 years. Now you can do partial term. So I can say, look, I just want to be floating for the next 3 years, or I want to be floating a year from now. So you've got the ability to customize your assets. And the reason I think this is so important, when we come out of this, and we're going to come out of it, and we're going to come back to fighting tooth and nail for deposits and loan growth again, right? Isn't it better to have these tools in our toolkit so that we can go out and make sure our customer gets what they want, but I'm not forced to take their interest rate risk, right? It's the Amazon world. Don't put your interest rate risk problems on your customers, right? You can't do that anymore. So having these tools in your toolkit, bring somebody in you know who you trust to walk you through these changes, how they've been simplified, and why it makes a lot of sense potentially to use at the appropriate time. So I'm going to give you an example or two of what we've seen people do. Third one, and this might be controversial, especially on this call, but I did want to mention it. I get the question a lot, should we modify our debt? Right? We've got a home loan bank advance that we took out 2 years ago that at the time it was the right transaction. I needed that protection. The world has changed. My asset base has turned over, and those liabilities are still outstanding, and they've got 2 to 3 years left. And the question I get is, should I use the old EITF 9619 debt modification or extinguishment of debt, right? The treatment where you can blend and extend, or some people call blend and pretend, right? Where you take an advance, you prepay the advance, you take out a new one, and you amortize the loss over the life if you want to get modification treatment. I'm not a big fan of modification treatment, having gone through the last decade and seen what it does. If the advance doesn't fit anymore, raise your hand and either pay it off or live with it, in my humble opinion. I think modifying it and kicking the can down the road, I don't think it really makes a lot of sense unless it's a one-off occasion where you're incredibly liability sensitive and you don't mind the extension, but you're going to be paying an above market rate for even longer. So I'll go through an example or two of what I would do going through that. And then finally, I already talked about it, but the other developing theme we're seeing is that there's attractive sub-debt being issued, and it's just really interesting to take a macro view at this for 30 seconds. We're going through a worldwide pandemic where people aren't even really allowed into their offices, unemployment levels where it is, an election coming. And I'll tell you, in 2008 and 2009, our company wasn't raising offensive capital in the form of debt, right, for institutions. Today, we're doing it at record pace. I thought last year was a record. I think we're 2 to 3 times the amount already of where we were last year. And partly because we're pretty good, partly because that's the market. So pay attention to who's raising the capital and why they're raising it. It may be an attractive asset for you, or it might be a way to solidify your capital stack at still attractive levels, especially when you think about after tax and when you think about tax rates potentially going higher in the future with the political climate could change a little bit. Okay, I promised you a Scott crazy decision matrix around this TCE and tangible book value, and this is not perfect. But to me, I think a lot of CEOs, and I know maybe some of you are even on today, so don't get mad at me, but sometimes the CEOs get more frustrated with the mark-to-market in a bond portfolio than maybe a chief financial officer or an asset liability modeler, because I've always viewed those assets as my front line to how to manage my interest rate risk. And so I'm willing to have a loss down the road to help protect me and get me through tough times today. As long as that loss is manageable, I don't have to take it. It's not credit. And so the first thing I want everybody to think about when you think about this TCE, available for sale issue, is you have to understand if you've got an economic problem, i.e. I'm a very liability sensitive bank, liability sensitive credit union, then maybe I start thinking about addressing the tangible common equity issue using a risk reducing transaction. But more times than not, it's institutions that actually are on their hands and knees praying for rates to be higher, and they're worried about their bond portfolio going underwater in a rising rate environment. Then that drives me completely crazy. So what I've tried to do is to try to show you a decision tree to understand, do I have an economic interest rate risk issue up in a rising rate environment? That's a different discussion. If all I have is a bigger bond portfolio that brings an OCI mark that at one point in time might be higher than some of my peers, I'm not worried about that in the least. Because as I go to the next slide, I've always learned bank stocks trade at their highest when bond portfolios are valued at their lowest, right? I've never met an investor who bought a bank stock because of their bond portfolio. They won't buy a bank stock sometimes because of the bond portfolio, but they'll never buy it for that. They can do that themselves. And if you don't believe me, look at this little graph we put together here, where I look at price to tangible book in the blue, and I look to unrealized gain benefit to your tangible book value due solely to the available for sale bond portfolio. It works in exact opposite of each other, right? So you go back to 2006, right? The world was great. Banks were trading on average 170 a tangible book. The world was great. Look where your bond portfolio was valued. Below par. You had a loss. Nobody cared. Look where you were valued. Fast forward, 2011 or 12. We had our big shiny gains in our bond portfolio because we're great bond pickers. Look at the valuation of my company. Below tangible book, right? Coming out of the credit crisis. And it ebbs and flows, but they work in opposite. So do this for yourself and look at where you've been. And this might start to get you, again, a little bit more comfortable buying assets that you're acknowledging at some point. If you're doing your job, you should have some losses in the bond portfolio. Those losses are accounting losses, and they're not interest rate risk marks. Excuse me, they are interest rate risk marks. They're not credit marks for the most part, right? We're buying agency-backed securities for the most part. So all it is a change in value due solely to changes in interest rates. So just a point I wanted to make sure I pounded home today, while it's not an issue, because I do think it's going to be an issue. Couple quick points here. I mentioned asset side hedging and derivative use in general. and I got very lucky early in my career that I was not smart enough, and I mean this, to sit on a derivative desk and trade options or package any type of credit default swaps or do any of that. I was never smart enough. What I was able to do, and I got lucky, was I ran more interest rate risk models than anyone at my firm. I can actually say that. And I was able to be exposed to so many different balance sheets that when the topic about 10, 11 years ago of derivatives really started to show its face to me, I came at it at a much different approach than my competitors. Not right or wrong, just much different. I am not a classically trained derivative marketer. I never will be. I don't want to be. And some of my competitors who do fantastic work in the derivative space come at it being a little bit of a hammer, right? Somebody told me once, don't be a hammer, because when you're a hammer, everything looks like a nail. Same concept in the bond world. I didn't grow up selling bonds. So anytime somebody calls me and says, I have an interest rate risk problem, if you go to a bond heavy shop, they're probably going to try to fix that problem using a bond. No shame, and it might fix the problem. But the same issue happens, I think, in the derivative space a lot. People go to a derivative company. They say, I've got an interest rate risk problem. How do you think they're going to develop their ideas? through the use of interest rate swaps. So I'm lucky enough to just be an asset liability modeler. There are times that derivatives make sense. There are times they don't. And when you come at it, thinking about it with your balance sheet, your interest rate risk exposure, you'll start to look at things a little bit differently than coming at it in the bond world or the derivative world or an advanced world or a deposit world or wherever your expertise is. Make sure you bring somebody in who's going to hammer home when you talk through derivatives that it fits your institution. It's a hedge. It's a protection. It's a form of insurance. And we are not here betting that AIG fails in credit default swaps, right? And so we got very lucky, and I started our company, Piper Sandler Hedging Services, originally Sandler O'Neill Hedging Services. I started it about 5 years ago. I've been in the derivative world a lot longer than that. But I felt that there was a need for that type of approach. And I got so lucky for two reasons. One, FASB came out and changed the rules and made it easier to utilize derivatives. So that was luck. And also it was lucky that Dodd-Frank came out. And a lot of people look at me like, wait, Dodd-Frank, why do you think that's a positive? They really drilled into the derivative world, they wanted to make it clear that there was going to be absolute transparency between the dealers and the banks. And so that is such a powerful thing that everybody has taken a step back. They know exactly where the market is at all times. And now truly you're just trying to think about all the tools in your toolkit, assets, liabilities, off balance sheet. And so we got lucky with FASB. We got lucky with the regulatory world. And I'll even take it one step further. The examiners have invited me down twice a year for the last 4 years to come down and walk through an hour and a half. It is long. It is painful. I feel some of your pains that you all take with your examiners. And we go through derivatives 101, what it's going to look like, what the strategies are. And I give them a lot of credit. They don't have to invite a guy like me down there to talk about it, but they're seeing it more and more on balance sheets. And so when you're seeing examiners and accountants both coming together saying this is a better tool than we originally thought, let's make it easier, let's understand it and make it transparent, we got lucky in my world. And that's really, in my humble opinion, why. I wish it was because of me. It's not. It's because that's why derivative use is up so much. So I talked about asset side hedging. And quickly before I get out of your hair here, asset side hedging, I think, was something that I never talked about. And now we talk about it in so many different forms. A customer back-to-back loan swap program is so powerful. It can turn your bank into a more powerful institution. You can go compete against the largest banks in the country, and you can drive really valuable fee income. If you're publicly traded and large enough, and you don't have a back-to-back customer swap program, a real one that you're running, I think that's a mistake. As spreads get tighter, margins get squeezed, fee income, my humble opinion, how people are going to be valued, your deposit base, fee income, and management teams. Here's a great way to drive fee income in that back-to-back customer swap program. Second, asset side hedging. If you're buying assets right now, one of the assets you've got to go way out on the curve to see that steepen in the municipal world. We've had a lot of our banks buy long-dated municipals, hated buying those types of maturities, right? And swapping them to a floating rate and using the fair value hedging, and many times even getting shortcut with no P&L impact at all. We're seeing it in the security world and the loan world. It's a powerful, powerful tool that can help you manage your TCE risk, can help you manage your interest rate risk. And by the way, going from fixed to floating, have you looked at the swap curve? It's as flat as a board. So the earnings you're giving up from normally going from fixed to floating is so minimal that people are kind of like, you know what, I'll go a little longer. I like that credit, and I'm just going to swap it to a floating rate, and I'll at least take interest rate risk off the table. So it's something that you could at least consider. And I gave you boxes and arrows. Again, you can tell I'm not classically trained derivative marketer. I like seeing the way it works and starting from there. So this is an example of buying a fixed rate asset, and the longer dated fixed rate assets get a little wider spread too, because people don't want to go out that long. Do it yourself. I call it my DIY floater, right? Buy the longer dated fixed rate asset and just swap it to a floating rate. And now you've got the best of both worlds. Real quick, and then I'm going to turn it back over, I think, to Tom to make sure we have any questions or any arguments with some of my points today. I wanted everybody, before they modify their debt and they use the very user-friendly accounting guidance around modification of debt. I just want you to think it through before you end up doing it, because I saw a lot of people do this. I want to say, I guess I'm getting old, about a decade ago, 2010, 2011, and Adam may correct me. He saw probably way more than I did. I saw a lot of people push out maturities, right? Because the curve's flat and they modified the debt and they didn't take the loss. I'm here to tell you, I actually like taking the loss, ripping it out and extinguishing the debt. But if you're coming and thinking about modifying it, before you do that, here's an institution that came to me, and I thought this was a really good example of why I like derivatives sometimes to combine with home loan bank advances, because I think the combination is a powerful tool. This bank had $10 million of a federal home loan bank advance. They were paying 2.5% on it. They put it on 3 years ago, and they still have 2 years left, I think October of 2022. And so what they were going to do is they were going to blend and extend it to take the maturity out to 25. The rate would go to like 175, 180, ballpark, somewhere in there. So they lowered their cost, which was great. They added duration, which might be a good thing on the liability side. But the problem is you're still paying 180 for now. Now you're going all the way out to 25. Mathematically, the way I like to do it is to say, look, I've got 10 million at 250. I can't take the loss, or I don't want to take the loss, or I'm philosophically against losses. And by the way, if you are, call me someday. I'd love to walk you through why I love losses. Here's what I would do. The Home Loan Bank has always been there for me, and they will continue to be there for me. So why am I not leaning on them here? And what I would do is I would say, look, I've got $10 million outstanding. It matures in 2 years. I want to make sure I don't miss this opportunity where interest rates are today, right? Because we look at where interest rates are today, and I can put on 3, 4, 5-year money at unbelievably low levels, but I don't need any more money today. So what I do is I look and say, okay, I'm going to hedge the refinance risk I have on this existing advance. I know when it matures, I'm going to go back to the Federal Home Loan Bank. I've always had some form of wholesale funding out there. It's my duration play. So all I'm going to do is enter into a forward swap that, you guess, starts exactly on the maturity date of your old funding. In this example, we said, let's enter into a forward starting swap that starts on October 31st, 2022, and will mature in 25. So the same example, right? And now you're going to go from paying $250 for 2 more years, but your back 3 years are locked in at 52 basis points. For me, I'd rather have that. That's probably when earnings are going to matter more. I'm still going to think about the home loan bank and the interest rate risk protection. I just would rather do it that way than a modification of debt. 10 years ago, derivatives were much harder to utilize, and I think a lot of people ended up erring on the side of caution using the modification tool. It's a great tool. Don't get me wrong; it's out there, and it's a transparent one to utilize. So I'm not saying not to do it. I'm saying explore extinguishing, explore modification, and explore forward starting swaps. All three can be a great tool for you. And I'm going to quickly just here, I think, wrap it up. One other thing I wanted to mention, and Adam mentioned this early on LIBOR going away. There's been a release on ASC 848. And one of the things that's really neat here is that a lot of us have swaps on the books tied to LIBOR, that you've now got the ability to make some changes here. And this is a 45-minute webinar in and of itself, but you'll have my slide here. Call us if you want to walk through what your options are. The protocol, the ISDA protocol is coming out October 23rd. The ARC, FASB, everybody has come together, and this transition, I believe, will go smooth, especially in the derivative world. I think not as much as securities world, and certainly maybe not in the loan world. That'll be on individual institutions. The derivative world, they're all over it. It's going to go to SOFR. We'll lay out some guidelines, but again, there's an opportunity here to take advantage of that, and it's a much more encumbersome type of conversation. But I just wanted to mention it here for you today. So before I turn it over to Tom, hopefully I didn't run into too much of my time. I always like to kind of leave you with my key points, right? Clearly define the difference between tactics and strategy. What part of the yield curve matters most to you? How do you and other important stakeholders strategically define your liquidity position? You can't make a game plan with this cash without answering that question. Evaluate replacing credit risk, not adding credit risk. Sell what the Fed's buying, buy what they're not? Do you have any inefficient leverage that lives on your balance sheet? Explore hedging tools. I cannot be more clear on this. I'm not saying you need to do them. You need to understand them because they allow you to play offense in the loan world, in the deposit world, in the home loan bank world, and in the securities world. They allow you to not put interest rate risk on your customers and allow you to manage your own interest rate risk yourself. Be aware of tangible book value and tangible common equity ratio, potentially being diluted in a rising rate environment. And the sub-debt world is wide open. And when things are open, I like to take advantage of them. If you try to understand it as an investor, as I mentioned, I wrote a white paper on if I've never bought one before, what would I do and how would I look at it? Reach out if you want to see that. And if you're an issuer, obviously the markets are wide open and we could always be helpful there as well. So Adam, Tom, everyone at the Federal Home Loan Bank in New York, I can't thank you enough for having me for 45 minutes or so today. And I know virtually is hard. I tried to show my ugly mug in there. But again, I hope everybody's doing well. And again, I really appreciate you taking the time. And I'll pass it back over to you, Tom, and we can kind of maybe take some questions if there are any.
Sure. Thanks a lot, Scott. I appreciate it. Appreciate all the information you shared with us today. Did have a few questions. One question to start off with, you were talking about liquidity on the balance sheet. One member had asked about an acceptable ratio for cash and unencumbered securities as a percentage of total assets. What do you usually look for in that?
Yeah, my minimum's typically 10%. Again, I've got to look at your deposit base. If you got a lot of muni deposits, I've got to look at what your wholesale funding position looks like, and typically your cash flow and your investment portfolio. But I like to create a minimum of 10%. And we saw that come into play 2-3 years ago when, we're fighting tooth and nail for every deposit to come in. And so things were a little tighter there, and it was expensive to own bonds. So we were just trying to lend as much as we could. So Tom, I'd say a minimum of 10. Go back and look and see if you've been around that long historically, where you were in 06 and maybe where you were in kind of 15, 16, see how low you got. And maybe give yourself a minimum of 10 and a target of maybe between 12 and 15.
All right. Thanks a lot, Scott. Another question members often have, and someone's asking here today, are what are some of the things that you consider when you're making the decision to either retain mortgage production or selling it right now at this time?
Yeah, no, that's a great question. And I think I always go back to my boring mantra, Tom, of first and foremost, does that asset help me address an exposure, help me take advantage of an opportunity on my balance sheet? And what I mean by that is a lot of institutions are like, okay, so I'm going to originate this mortgage. I'm going to underwrite this mortgage. I'm going to sell it, take the cash and go buy an agency-backed mortgage at a lower yield, right? So for me, in this world right now, where if my loan pipeline is down and I can take some duration and add some duration here, I love that trade. Because I think you're going to have to buy more bonds than you want. These are bond-like assets that you understand, obviously, very well. So for me, again, it starts and stops with my own balance sheet. Can it help me take advantage of an opportunity? Does it help me address an exposure? And if one of those is a yes, then I really like I really like that strategy. It should be on everyone's table, not necessarily doing it or not, but it should be discussed.
All right, thanks, Scott. Last question. One of our members wanted you to just address a negative rate scenario. Right now, at this time of the year, strategic planning is occurring, and I wanted to get your thoughts on negative rate scenario and how that should be incorporated in the strategic planning process.
Yep. No, and it's a good one, and we've gotten a lot of questions. And when we first started getting this question, maybe 4 or 5 years ago, I was just worried our asset liability software, we start seeing smoke come out of the computer screens. I wasn't sure we could mathematically do it. I think the math is easy. I think you can go into your model and give a thoughtful approach to negative rates. Now, there's a couple of things that I think that are intangible that you need to address if you're going to your board or ALCO and talking about negative rates. Number one, are you really going to charge depositors, right? That's a fundamental question. You better be able to break up commercial versus retail, because in the commercial world, you might be able to do that. You may be able to do that because there's so many benefits you bring to them. I look at the Europe model. right? The Europe banking model, their spreads are starts with a 1 at best. They do a better job feeing. So fees are going to come into play here a lot more. And so when you think about negative rates, you've got to think about a couple of things. Is the entire curve going negative, right? Or is it certain parts of the yield curve, right, that are going to go negative? That's number one. Number two, are you going to charge your retail customers who have left money with you, right? That's a fundamental question. And I think the third question is, I've always seen spreads widen on origination of assets when interest rates drop low, right? Like, you can only get so low in the mortgage world. Now, I don't know if the 10-year went negative, if spreads would widen and it would still cost me 2.5% if I wanted to take a mortgage today. I don't know the answer to that, but you need to be able to answer that to your board and ALCO of how you approached it. So it's going to be those key assumptions, along with making sure refinancing on commercial loans, your floors will probably, if they're embedded, are going to get refinanced out. It's why I actually love purchasing floors separately, but that's a separate topic. But it's really about your deposit base, how you're going to treat those deposits, right? It's your asset mix and spreads widening, or are you going to go with the market, right? And it's parts of that yield curve that will go negative, or is it really a parallel shift? I think that's a really important point too, because if we go negative, is it really going to be across the curve? And that's a different question than maybe just the short end or the long end.
All right, Scott. Well, thank you for presenting today, Scott. Really appreciate all your insights. And that concludes our session for today. We thank everyone for attending, and stay tuned for our future educational content. We'll have some more content upcoming as the year progresses. So thanks again, Scott, and I appreciate everybody's time.
Thank you.
Okay. Bye-bye now.